Hey, good morning, everyone. Thanks for joining our webinar, Oaktree Funding's the Expert Guide to Short-Term Lending. We're just going to give everybody a couple of minutes to get logged in here. I know we had some folks on hold for a minute, so it's just after 10 o'clock, so we'll give everyone 1 or 2 minutes just to get logged in, and then we'll get going, so everyone can get access to this great information. All right. All right. Looks like mostly everybody's getting logged on. I want to welcome everybody to our webinar this morning, Oaktree Funding's the Expert Guide to Short-Term Lending. I am Chris Martin. I'm the co-CEO here at Oaktree, and I'm excited to have with us Matt Fernandez. He's our short-term lending expert. Thank you so much for joining us, Matt.
Happy to be here. Thanks, Chris.
Got a lot of great information to cover today, so we're gonna go through it. There are two different boxes, if you'll notice, on the right-hand side of your go-to webinar guide. There's a questions area and there's a chat box. Obviously, the questions area is where we prefer you send your messages. You can send it to everybody so everyone can view your questions, or you can just send it to us, and then we'll be the only ones that can see it. And then we can ask your question either discreetly or publicly, whatever you guys would like. If at the end of the meeting, if we have some time left over, we will try and open it up to more questions. But you know, again, we do one-on-one training for groups and individuals. You reach out to our marketing department. We have links on our Calendly, links on our website that you can schedule training for yourself individually or for your team. And we'd be happy to answer any questions that you have. But we're going to get going on the webinar. So thank you guys all for joining us this morning. So we talk about short-term lending. We're going to go through a few different areas here. Why short-term lending? What's an STL borrower? What are the benefits of RTL or STL lending? Why Oaktree? We're going to go over some specific product information, and then we're going to overcome some objections and give you guys some sales ideas on how you can go out and market and sell this product to your client base. At the end of the day, the most important thing is finding those investors, and that's what we want to help you do. Your why. Why short-term lending? STL, as we're going to reference it throughout today's program, stands for short-term lending. Our STL products are meant to serve as interim financing between a more permanent long-term financing solution or the sale of the property. So anytime we enter into these loans, we're always going to ask important question: what's the end game? How do they plan on getting out of the deal? They're getting into it. What's their plan to get out of it? Is it going to be a loan? Are they going to take out a DSCR loan? So loan officers, are they going to do 1 loan or 2 loans with you? Maybe 3 or 4 or 10? Who knows, right? You know, what are some other? What's the plan? Are they going to sell it as a true fix and flip, where they're going to be like the guys on HGTV and fix up the house and sell it for, you know, $100,000 profit, or double their money depending upon what area, who you're listening to, right? But this is what even the pros use for financing for those things, so they can do multiple projects at once. We provide real estate investors with multiple financing solutions to support multiple investment strategies. So like I said before, we offer fix and flip or rehab and hold, right? So you're going to fix it up and then you're going to hold it long-term as a rental. We offer new construction. So for an experienced investor, we'll give them the opportunity to build houses on spec. We have short-term and long-term rental strategies. And there's a very cold strategy there. I'm actually not sure what that is.
Yeah, that's like, you'll hear that term used a lot out in the world of property investors that do this strategy, right? When it's, what that all stands for is, I buy it, I rehab it, I rent it, I refinance it, and I repeat the whole thing over and over again, right? So
Perfect.
I acquire a property, I put money into it, I get it stabilized, I refinance it, pull my cash back out, and I go find another property and do the same thing. Just keep building a portfolio.
Perfect. And that's what we want, right? We want property investors that are going to be, that you're going to use this program to get them the first loan, and then they're going to do another loan with you for the DSCR program. Then they might do another loan and refinance it and cash out in a couple of years. And then they get to take that cash out and invest it in another property. Hopefully rates go down. Let's see here. Somebody did ask a question. Is a construction only for seasoned investors? Could a novice investor qualify for those as well? To start, we're going to get to that in a minute, but I'll quickly answer Ryan's question here. And that is, to start, you have to be an experienced investor to do the construction. What's that experience? And we'll get to it, I know. What's the experience entail?
Yes, you have to have two experience. We don't require that they have to be actual construction experience though. So if you did 2 rehabs, that would qualify you to do a spec build, which is nice.
Perfect. All right. Thank you for the question. I appreciate that. We'll get into the credit score stuff. If you hold some of your questions, we're at page like 2 of 30 on the slide deck, so we'll get to all of that stuff here in just a second. I think Matt froze up for a second, so we're gonna move on to the next one here. So some of the short-term lending basics. The term of these loans that we're offering is 12, 18, and 24-month terms are available for experienced investors, and the payments on those are interest only. The loans can be used for a purchase or a refinance. And all of our loans, just so we're clear, these are all business purpose loans, so they're all for investment properties. We don't do any type of construction financing for primary residences. We don't do any type of construction finance or rehab financing for primary residences, or even bridge for primary residences. These are all business purpose loans, and we prefer that they be in the name of an LLC. Oh, Matt dropped off.
I'm still here, so I lose my video.
Oh yeah, you lost the video. It's okay. It's all good.
Okay. I'm not that pretty anyway, but it's fine.
Oh, we appreciate it. So talk about the properties here for a minute, and I promise that we will get to your questions. But our bridge loans. So a bridge loan is just is what it is. It's a short-term loan. It's a loan to get you from, if somebody maybe have a property for sale. They haven't closed on it yet, or they're listing it for sale, but they need the funds to buy the next property. So we can do a bridge loan. In that instance, we do require that the bridge loans are as is. Loans that require appraisal, loans will require appraisals that consider as is and as repaired value. So if there is a construction component, a fix or flip, then we will do an as repaired value. So there's 2 different types of things that will allow an appraisals. If it's a standard bridge loan, it's got to be as is. If it's going to be a fix and flip, then we're going to be looking for an as repaired value. And it says on here, to determine the as repaired value, the appraisal will use the borrower's submitted rehab budget. They'll consider the work being completed on the property and utilize sales comparables with properties with conditions similar to the future condition of the subject property. So when we talk about, we'll talk about loan to value. So we'll talk about LTC, which is loan to cost, and we'll talk about ARV, which is after repaired value. So those are the 2 big things. So if you're a loan officer that's never done one of these loans before, you're used to dealing with LTV, and the LTVs it's somewhat subjective. So your purchasing is based on LTC loan to cost, and then when we look at what's it going to be after everything's all said and done, that's the ARV, that's the after repaired value. And Matt, jump in if I'm missing anything, please.
No, I think that's right on, but just a little detail there is that your investors typically, when they do a budget, right, for their rehab work, they're trying to budget to spend as little money as they possibly can to get the most value they possibly can. But what they have to understand, and you can help them understand, is that when they give the budget to us, they're really presenting what that property is going to be like to the appraiser. And it's key that they let the appraiser understand like the quality of finishes they're doing, like exactly what they're doing. Are they doing 1 bathroom? Are they doing all bathrooms? Are they doing the kitchen? These things are important to drive that condition rating for that appraiser to get that ARV right, because you don't want an ARV to come back short and constrain your loan amount down just because the appraiser didn't understand the extent of what the borrower is doing, right?
Yeah. Well said. Thank you. All right. As we continue on talking about what kind of properties we'll do, currently we're 1 to 4 units, including condominiums and townhomes. We will do a property we'll do a loan for a property for a maximum of 2 acres. Again, typically we're not going to see a lot of investment properties with more than 2 acres. As always, if you had one that has 2.5 acres or 3 acres, ask. If it has 50 acres, the answer is no. But if you've got something with, reasonable, we always are able to look at different things. Must be weather tight at the time of appraisal for fix and flip and hold. Could you go into a little bit of detail on what that means, Matt?
Yeah, I think really what we'll see is what we're trying to stay away from is like projects that are failed projects or things that are mid-construction or mid-rehab where you've had somebody take a roof off, somebody take some walls down, and the property is sitting there exposed to the elements, right? So those are projects that we just can't finance.
Right. It leaves it subject to mold and squatters and who else knows what, animals, who else knows what
additional. Lots of problems.
Yep. All right. Plus, one of the requirements is that these things have insurance on them, and I can guarantee you that if it's like that at the time of the loan and they're trying to get new insurance, they're never going to get insurance coverage on it either. So, all right. Let's talk about the borrower a little bit. What is a short-term lending borrower? Typical borrower is an experienced investor whose primary source of income is the acquisition, renovation, and sale for profit or hold for profit of investment properties. We will allow investors with no experience if the loan is a light rehab at a reduced leverage. That means at a lower loan to value, essentially, right? We will allow for property investors that have not done it before, because how else are they going to get experience? They have to have that opportunity at some point. As long as it's not a complex rehab, like they're not taking down walls and completely refurbing the stuff. A light rehab is like paint, carpet, tile, maybe appliances, right? So that's what we're looking for there. Some of the benefits of doing short-term lending, aside from the obvious of the loan products themselves, there are some specific benefits to these types of loans. No TRID, no RESPA. These are business purpose loans. So they're very, so as you know, in many states, the licensing requirements are not there at all or much reduced for business purpose loans. These are faster closings. The documentation requirements are very limited, and only time restricted element is the appraisal. So a lot of times, we pull, you got income docs that are 30 days, they're good for 30 days. You got bank statements and assets and all this other stuff. None of that's going to come into play here. We have a lot more flexible underwriting guidelines. There are, of course, hard stops, but every file is a manual underwrite, meaning that you can have a conversation about a file and try and make it work. Underwriters are motivated to solve problems, not find problems. The entire purpose of this entire group that we've put together is to make these loans, not to find reasons not to make these loans. This is built for repeat business. And I'm going to let Matt touch on that in just a second after I kind of get through this bullet point, because that's key here. But once a borrower file is built, most documentation is reused for future files, meaning the next file will be even easier and faster than the first. And Matt, if you could kind of touch on maybe some of your experiences on why that's huge.
Yeah, and I think what we do is we see, our customers typically use an LLC. They can use other entities to borrow it, but it's typically an LLC, so that needs to be reviewed by our legal team. So you get kind of this review done of all their entity docs. You make sure that's all in line. You know who has to sign at the table based on the docs and what they say. Like all these things get figured out on that first loan, right? We pull their credit, we keep that. That's good for 120 days. So any transactions they do inside that, we don't need new credit. Assets are a little bit trickier, but we only require one bank statement. You don't need 2 months. The large deposit requirements are very liberal compared to what you're used to on like a agency kind of definition of a large deposit. So we don't really have to source funds too often. It's also very easy for us to use funds from anybody who owns that entity, even if they're not being a qualifying guarantor on our loan. So there's a lot we can do to work with there, and the flexible underwriting piece I think too is important, and it's really this whole world of rehabs and projects that people are doing is really the biggest driver of what we can do flexibility wise is experience, right? So somebody who does 20 flips a year, and they want to do something and it's a little outside of what we think we can normally do. Well, that guy's done that 20 times, in the last 3 years. We're going to be very, very, aggressive as far as what we're going to allow, right, for that customer. Whole different story if somebody's coming in and they're saying like, oh, I'm going to convert this church into a 8-unit property. I've never done any flips before, but this is what I'm going to do. That's something where we'd say, well, that's, you don't have the expertise to really pull that off. So we're not going to go outside of our guidelines for that customer.
Those are great. So on that vein, we had a question from Vicky. I'm just kind of going through the questions. Possibly could be is this only residential, any commercial?
Yes, it's residential purpose only, right? But there's a little bit of confusion there, right? Because 5+ unit properties are considered commercial. And so we're good with 5+ unit properties on these products, but they have to be residential purpose. They can't be mixed use, or they can't be restaurants or office space or anything like that.
Okay. And then Stephen Goldman, I'm going to get to your question, I promise. We're going to get there in the slide, so I'm going to save yours. But Francisco had a question. Are replacing appliances only okay with a fix and flip?
It can be done. I mean, I think most customers who are looking to just replace appliances and put a tenant in there or sell the property are not going to want to. I guess if they're going to sell the property on exit, maybe they want a fix and flip loan, but they'll typically maybe want a bridge.
Right.
But if it's somebody who's going to hold the property rent, they're going to want that DSCR loan. They'll do the appliances later.
Right. This is not an FHA loan, even on the DSCR loan side, Francisco. So we have a lot more flexibility than like Fannie Mae or FHA's requirements that require like certain things to be in the house. Now we have certain requirements as well, but we can work with you on that generally quite a bit. So, and then one last question, since you brought it up, how is seasoned funds looked at? That was Francisco's other question.
How are seasoned funds looked at? Is that the question?
That was his question. Like, how do you determine?
So, I mean, the reality is we're getting 1 month bank statements. So as long as there's nothing coming in on this month's statement, then there's not going to be anything being sourced. I can't recall the exact percentage off the top of my head on what a large deposit definition is, but it is, I want to say 20% of the required capital to qualify, something like that.
Okay.
Pretty big number. But it's probably worth pointing out that like there's no way we can allow any gifts in this for these loans. These are investor loans to people who are doing this as their business, right? So there aren't any gifts allowed. There's no gifts of equity, interfamily transfers. All that stuff is prohibited.
Okay. That's pretty standard. Really looking at making sure we're not laundering money and things like that. So, and then I'm going to do one more. I'll do 2 more questions. One of them I can answer, and one of them I'm going to ask you to answer, Matt, if you don't mind. If it was mixed use and is being purchased and converted to residential only, is that okay?
So any use conversion is going to be by an exception basis only, and there's a lot of reasons for that we probably don't need to really get into because it's kind of unique. But anytime you're going to convert a property use, let's say you're going from a SFR to a 5-unit, or you're going from a 2 to 4 and you're going to make that an SFR now. Anytime you're changing what the property is today and it's going to be something different tomorrow, that's going to be something that you're going to have to vet with us first, and we'll look at each project, as it comes in. And another big driver there is going to be experience, right? If you have a customer that's what they do, and they take those properties and they convert them, and then, in their market, that's something that we look at and be pretty aggressive with. If it's somebody looking to convert something that, has no experience, it's going to be harder.
Right. Okay. Thank you. Owen, I'm going to get to you after your answer's coming. Francisco, how soon can we sell a fix and flip after closing? I believe we're 6 months.
Anytime.
6 months minimum interest.
No, we have no minimum interest, so you can sell that the next day if you want to. I mean, obviously there's not too many customers that want to do that, and it's obviously hard to do that because if you're going to do any rehab work and you're going to market the property and actually sell it, we don't really see any customers getting done that fast, and we've done a lot of these. So, but we do not have minimum interest.
So said differently, there's no prepayment penalty that's charged.
None. Yep, that's right. Exactly right.
There you And then Christopher asked, I'm assuming broker comp is borrower paid only. Yeah, there's not any like, I mean, lender paid, borrower paid is more of a TRID thing. In this instance, these loans typically close with some type of a settlement statement with the title company, and we're going to have you know, you're going to build in your compensation up front on whatever it is that you want to make, and then that'll be just disclosed to the borrower and then charged at closing. There's no premium. Obviously, if we're only servicing the loan for a month or for a year or maybe 2 years, and they can pay off at any time, you know, there's not really any yield spread to be paid because there's no guarantee of this loan going to last for a couple of years. Typically speaking, we pay yield spread premium, you know, if we're going to hold the loan for 2 or 3 years. So, so that's kind of the thought process there. A prepay. I love all these questions. I actually like. I feel like I want to progress in the presentation, but these are great questions. I think that I really am very, very pleased that everybody's participating. So thank you guys very much.
Yeah, the field spread one's a good one that comes up all the time too. The reality is that most of our customers finish these things in 3 to 5 months. So if we're going to like let you put a point in the rate, we'd have to add like 4% to the interest rate to do that, which makes it really tough to sell.
Right. Hey, how about your 17.99% fix and flip? Do you guys want that?
Right. Yeah.
Okay, so this is probably a good one. I don't know if we cover this in there, so I'm going to ask this one, and then I am going to move on. So Denise, you're going to be the last question until I move on to get through a couple more slides here. Can you explain the qualifying process? Is the current PITI, the bridge loan payment, and the new STL all calculated into the DTI? I think I could answer that, but I'm going to let Matt answer.
Yeah. So one of the nice parts about these loans is there are no income considerations on them, right? It doesn't matter. We don't care about the borrower's employment, pay stubs, tax returns, how much they make or lose in a year. There's no analysis of whether or not they can cover the payments with their personal or business income. It's all about, you know, what their experience is, how much cash, do they have enough cash to get the project done, enough reserves to make the payments, right? Get out of the loan, whether they're going to sell the property or they're going to refinance it into a DSCR loan. We don't do any pre-analysis. If they say, hey, we're going to rent this property out and hold it, we do not currently do, and I don't think anytime in the near future will we ever do a DSCR analysis on a SFR 2 to 4 to qualify for the short-term loan. That there are qualifications though on the 5+. It's the only time that a DSCR is looked at like for a short-term loan. So if they're doing new construction on a multifamily property, they're rehabbing a multifamily property, there is a DSCR analysis done by the underwriter to make sure they can get to that exit.
Right. It's all looked at in consideration. So hopefully that answers your question. So and JB, so we can do first-time flippers. That it's just light rehab only. We can't do full, like a full-on, you know, full rehab, like a heavy construction project. And the rate range is going to be anywhere between probably low 11s to low 13s, just depending upon the borrower's experience, the leverage ratio, and those types of things. So there is a little bit of a range in rates. All right. Life of the loan. So you guys understand the process here a little bit. I think we took a slide out here on accident. Oh, no, we didn't. We need to get it right here. Oh, yeah, it's backwards. Okay, so I have to go backwards in the slide. I messed up when I put the slide together. So the life of the loan, the first thing that we're going to do is a loan analysis. And we've got a really cool system that's used, and it's very much automated process for us. We dump the information into the system, and then at about, I don't know, I think I did it yesterday. It was like 5 minutes max. I know exactly what my client's going to qualify for, and then we can deliver the client a letter of intent. We can deliver them, you know, an application request and those types of things. During the processing process, and that's one of the nice parts about working with us is that you're not going to have to really worry about processing the loan too much. We have an entire group of people that's dedicated to processing and underwriting these loans, to making sure that we get all of the information that we need to get, so that you guys can worry about going off and generating and originating more business than just being so, muddled down with this process. This is a lot easier process for you. We're not just, it's not just an account manager on like a traditional DSCR loan where you're going to work directly with the borrower. These are going to be, much more handheld by us, so that you guys don't have to be short-term lending experts. You guys can be, loan officers that are out getting and originating more business. And obviously, underwriting. You guys know what underwriting is. Closing. We don't draw docs in house. We use the Gerasi, pretty well-known attorney law firm that knows how to draw these docs correctly and give exactly what we need contractually done, along with if we end up wanting to sell the loan in the future to an investor. And then we're also going to handle the fund control, the asset management. So what that means is that your borrower is never really going to leave. Once you put it in our ecosystem, your borrower is never really going to leave our ecosystem. So it's all the contact, all the communication that you have with your borrower, that we have with your borrower, that's it. So when it comes time to do that DSCR loan and take them out of that fix and flip, guess who's going to do that? You're going to do that, not us. We don't have a retail department that's going to be going after that business. We're just going to be saying, hey, ABC broker, Mr. Smith, your borrower is ready the work's been completed. The guy's ready to do a DSCR loan and do his long-term financing on it. Please give the guy a call. We're all ready to go. Just take the application and resubmit it to us, and we'll take it from there. So that's one of the great parts about this program with you guys. There are some other places that I've heard horror stories that, oh, these guys took my customer and they did this and they did that, and that is not. And we don't do that. That's not our business model. We want to make sure that your borrowers come back to you time and time again, and hopefully you bring all those borrowers back to Oaktree. And then servicing, interest is charged on the drawn balance. The customers don't pay interest on the holdback funds until they've been drawn. So meaning that you get a loan for $100,000 and you use $50,000 of it to buy the property, and these are all wrong numbers, but and you take that, so they're only going to get charged interest on that $50,000 until they draw. So they go out and then they complete some work, and then they submit a draw request. Once the work's been completed and they show the work's been done, we get an inspection done, make sure that the work has been done, and then they get that money back, reimbursed to them back in their pocket. And then, so they did $10,000 worth of work. Now they've got a $60,000 loan. So whenever that draw amount comes out, at that point in time is when they start getting charged on the additional 10. They're not charged on the whole 100,000 the entire time. So that's kind of nice, similar to a home equity line of credit. Here's an example of how you would maximize your returns. Made a misspelling there, but on versus a rehab and sell. If you guys want to, and you guys are all welcome to screenshot this, and you're going to get a copy of this webinar was sent out to you, I think probably by tomorrow. So everybody who's on here will get a copy of the webinar that they're able to use. And we also have another copy that we're working on, so that if you guys want to do presentations for your real estate agents or for an investment group or whatever the case might be, we also have a version of this that we're going to be able to make available for you, so that you guys can use that as well. So these would be a lot of the things that you would use. Obviously, for buying the same type of property, using your own money, you can get a nice 15% or 14% return on your investment. The actual cash you invested, this is cash on cash investment, which is important to investors. 14% versus 57% is a big difference in my book. I know that if I had a fund manager that was giving me 14% or a fund manager that's giving me 57%, I know which one I'm going with. So obviously using leverage, using other people's money is a great way to help you kind of supercharge your investment income, and also allows you to do more than one property at a time. Because if you do one property using your own cash invested at $52,000, how many properties could you do if you invested $350,000, right? Kind of a no-brainer there. Buy, rehab, rent, refinance, and repeat. There it is. This is kind of the strategy that we were talking about earlier, Matt. If you want to kind of maybe go through this for a second.
Yeah, no, absolutely. And you kind of hear this out there. Am I getting feedback?
There's either, I don't know if I can mute everybody. Let's see.
Let me just tell them. Okay.
You're good.
Can you hear me okay now?
Yeah, you're good.
Okay. So we kind of talked about this a little bit earlier, but you'll hear that kind of burr term out there a little bit. The nice part about that for us is that, like we were talking about earlier, it does allow us to get 2 loans out of the same property, right? So we're financing that first short-term loan. We'll do up to 85% of total cost. So they can actually get up to 85% of the purchase price, depending on how they structure the loan, with it, as long as it's within the 75% of that ARV value that we kind of talked about earlier, right? So there's 2 kind of tests of how big your loan amount can be. One's based on cost, one's based on feature value after the repairs are done. Our typical structure is that the money from the loan finances the rehab first, and then the rest of it is going to be funded to the closing table. If you have a 5+ experienced customer, so your more experienced customers, we give options to, because you'll have some customers out there that say, I don't want to finance the rehab. I have the money and I don't want to deal with draws, and I'm good. We can do that for those customers that have 5+ experience. Or they may say, hey, I want 85% of that purchase price, and then you can just fund 85% of my budget. We can also do that for 5+ experienced customers. It's those lower experienced customers where, from a risk perspective, we're funding their budget first. We want to make sure they have enough money to get the project done. We don't want to count on like their personal funds and their experience to get the project done, right? Number 2, obviously, is your DSCR loan. So, of course, once you get your property rehabbed and rented, you can go ahead and do long-term financing, which they all like to do. They all like to try and take back usually as much cash as they can out of that deal. So they can get up to 75% of the new value of the house. So they have to get a new appraisal, because it's a different kind of appraisal. It's going to have a 1007 in it, and it's going to be based on what they actually completed work-wise on the property. And they can get up to 75% of that on long-term financing. And then they can use that cash that they're recapitalizing themselves with to go ahead and get another property with some short-term financing.
Thank you. I sent you a question. I'm not going to read it out loud. I'm interested if you have an answer, if you want to circle back and talk about that later.
I don't think I can see it. Something's wrong with my.
Oh.
You want to text it to me?
Yeah, we'll cover it in just a second. I was just being interested to see what it is. But, and then Terry asked, does the 2-point go to Oaktree or the broker in this example? She's talking about this example here. In this particular insurance example, we're just saying estimating 2 points. Matt, what do we typically charge up front?
So points is all going to be based on experience and credit score. So it does vary. And then obviously it is also very much determined based on how much you're charging as a broker. So I mean, you can charge up to 2.5 points on the deal, and that 2.5 is going to add on to whatever the borrower's base with us is. The lowest it will ever be is going to be 1.5. It could be 1 in some situations. And it'll go up from there. And obviously, what you add is going to be with you.
We're getting a couple of complaints on feedback. So I do have to apologize. I know we had somebody else that was going to be doing the webinar with me today, and Matt actually jumped on board to assist. And he is traveling.
Is that better? I said to kill some stuff here.
Yeah, I think that there's just people behind you and stuff. So yeah, child is screaming and crying. So I apologize about that. Maybe we'll just we'll mute for a second, and then I'll move on to a couple of these things. So the points here was just, this is just an assumption, Terry. So this is an estimate. It could be we're charging a point, the broker's charging a point. It could be, we're charging 1 or 1.5, and you're charging 3. This depends on 2.5. It just depends on the situation. It depends. It's going to vary from deal to deal. It's going to vary about experience, leverage ratios, these types of things. So it'll vary. So that was just an example. Obviously, the advantage of working with Oaktree in this process, as you guys can hear, Matt is an experienced, seasoned professional. He's been doing this for I don't want to date you, but I think over a decade, if I'm not mistaken.
Couple of them, yeah.
And everybody on the team that we're going to be working with on the RTL side has been doing this for a long, long time. Obviously, we've been doing non-QM DSCR loans since they were invented. Seems like. So Oaktree already has that structure of that working on with those investors. Investor-focused technology. We've got the pricing calculators, the quotes, and the applications that have been developed for this is absolutely top-notch, state-of-the-art, and we're excited. We're going to be getting that stuff in your guys' hands as quickly as humanly possible. It's going to start off. You're going to be working on that with the AEs, but you're going to have access to this very, very soon. Competitive rates and fee structure and customer service culture. We want to make sure that your borrowers, your investors, feel like they're taken care of, and that they feel like they're going to be able to come back to you because you brought them to the right place in the first time. And that's what we want. We want multiple investors coming back to us, multiple investors working with us, and then multiple investors doing their DSCR loans with us and that type of thing. So we want that repeat business. Matt, I'm going to ask that you answer this question because Brian's insistent. So we're going to go through it. Brian, I'm going to answer Brian's questions first. Are you a direct lender? Do you use your own money? The answer to that is yes. We fund on our own facilities and with our own cash. And then at times we sell loans and at times we hold them. It just depends on the strategy. It depends on the outlet. And then Ryan's question is, and he asked this question earlier too. So the question is, why wouldn't they use hard money if the rates are so high? And then can you please compare it to hard money? And I think that hard money is a loaded question because I think it's a nomenclature type thing. It's private money. That's what this is. This is private money financing. This is a version of hard money, I think. But I'm going to let Matt kind of answer that question more in depth because he's probably answered it more than I have.
Yeah, and I think certain markets have hard money available and some don't. Some have better terms and some have worse terms. I think what you'll find with hard money is that the fees and the points are going to be typically higher than what we're offering. They'll usually, however, go higher leverage. They will not go as long a term. They usually want 3 months, maybe 4 months at the most. They will not work with your customer if there are any hiccups, if there are any delays. They will be very aggressive to enforce their mortgage. We do not want properties. We want our customers to get deals done. We want them to get their projects done. We want them to exit, make money, and do it again and come back. So that's why we've built this to be much more easy to deal with, much more friendly for the investors, provide them better service. Obviously, we do diligence on our side, which some of the hard money players don't. Some of them don't require appraisal. They don't require title. So they're taking a lot of risk there. And in some markets, it is competitive with our product, but in most, it's really not.
Right. So that's a great question. So we're doing, obviously, a little bit more look into the deal. We don't want to take the property back. I don't, listen, not all hard money lenders are created equal and everybody lends their own money at different rates and fees and terms. But I've got a neighbor that does hard money lending and his interest rate is 18%. And, oh, okay, that's great. 18%. Yeah, well, you get great credit. Fantastic. 18%. That's it. That's the rate. And it takes on a lot of risk and it's max about, what's your LTV? 65%. So, I mean, we're going much higher leverage. They have much higher rates. And if they're not charging that high of a rate, you can rest assured they're charging 3 or 4 points.
Or they're charging Dutch interest too. That's another thing that they like to do, right? They'll charge you on the full amount versus just what they're giving you at the table.
Right. Somebody mentioned that the hard money does not offer rehab loans, and it sounds like some do, some don't. I don't know everybody that's out there. And if they are going to offer rehab loans, you're going to pay interest on the entire amount of the outstanding loan, regardless of whether or not regardless of whether or not you're able to, you're borrowing against that money at any specific time. So let's see here if there's any other questions before we move on. Oh, how quickly do, it says two, I think it meant do fix and flips close, and what is the down payment needed? Well, I think the down payment needed is subjective. Then how quick the first one closes, generally it takes, I think, if I'm not mistaken, Matt, if I misquote, but this is what my understanding is, it takes about 3 weeks or so to close the first loan that we do with an investor, because there's additional work that needs to be done. We need to look at the LLC documents. We need to look at those types of things. But underwriting the property, it's however long it takes for us to get the appraisal back and then review any other outstanding documents. Anything else?
Yeah, we've closed them in as little as 4 days, which that's definitely an outlier, and that was a brand new customer. So it can happen, right? It's just everything has to align for that to happen. I think typically you're looking at 2 to 3 weeks to close a fix and flip loan.
Right. Great answer. Let's see here, Francisco, I'm gonna have someone call you because you've got lots of great questions and you have a great, you got a great question here again. Is working with a real estate agent that has multiple investors with fix and flips. They'd like to be done in 21 days. Sounds crazy, but can they do that? I guess they have been doing it already with another lender, but they hate their process. Francisco, I'm gonna have somebody call you. If you could message me and chat with your information, I'll have someone give you a call. We can get you helped out right away. What are the max LTVs again, and does it vary based on property type?
So it's 85 of cost and 75 of value. And it really varies more by experience than anything else. So like the zero experience customer, they're going to be at 80 and 70.
Yeah. And Mark asked, I may have missed this, do you lend in LLC's names? Yes. Let's see here. Yeah, I'm pitching these like crazy and I need to answer all these contacts. Awesome. Francisco, put your information in chat and I will have somebody get back to you this afternoon, for sure, after this meeting. Okay, we missed a couple of pages on here. These are kind of our lending areas. Rehab, and we've kind of talked about a lot of these definitions before. I think you guys are getting the gist of it. Rehab and heavy rehab, short-term loans for investors to rehab residential properties, new construction, spec and production builders. My understanding is we've done loans for builders that are building an entire tract community. We'll also do them for somebody who's just wanting to build one single asset. It's just going to be depending upon how much experience they have doing that. Bridge loans.
Yeah, that's exactly.
Yep. Short-term loans for residential investors to acquire property, take cash out, pay off other short-term financing. No rehab allowed. Starting rehab would violate the loan agreement and they would be in technical default. And then new bridge loan, long-term loans, new bridge flex, long-term residential property investors to acquire residential properties, take cash out, pay off other short-term financing. Right. We kind of talked about this. We've been going over this quite a bit, and this is where you'll see a couple of questions above right when we first started. Steve Goldman was the minimum credit score for the products. Right there you go, 660. Obviously, there's a little bit of flexibility there, but that's where 660, that's where we want to be at. A no ITIN. They have to be U.S. citizens. Interest only payments, like we said, 12, 18, or 24-month terms, so you can go out to 2 years. Currently, obviously no prepayment penalty or minimum interest, like we talked about. Loans up to $3 million. We're lending up to 85% loan to cost and 75% of the after repaired value. The difference, can you please explain the difference between LTC and LTV? The LTC is based on the ARV. Gerald, that's a great question. LTV is loan to value, all right? LTC is loan to cost, right? And ARV is the after repaired value. So I'm not going to mess it up, Matt. Easiest
Yeah,
term.
maybe I think new construction might be the easiest example to think about. So, like, if you have a $50,000 lot and a $300,000 build budget, then that's going to be a $350,000 total cost. So we'll finance 85% of that, as long as the finished product, the loan divided by the finished product, is 75% or less. Does that make sense?
Perfect. I didn't want to overspeak. So good. Thank you. Let's see here. Gerald said makes sense. Perfect. For national loans are allowed. Okay. We do not allow for ITIN loans. Sorry, I did misspeak. So we do not allow for ITIN loans. Foreign national, are those okay?
We will do foreign nationals. They're different terms, but yes, we will.
Okay. All right. This mouse is very touchy.
The other thing there is too is that if they are foreign national, they have to borrow in the name of a U.S. entity. And there are other things too, like if you have a foreign national owning it with a U.S. citizen, you can use the U.S. citizen as the qualifying guarantor, and then the foreign national can just sit there owning the entity, and then you don't have to worry about that stuff. But you know, we're happy to help you with those situations when they come up.
This is a newer product that I'm not as familiar with. Can you kind of go over the Bridge Flex product, Matt?
Yeah, so really kind of what we did there is that we realized that we could use some longer term financing options out there to work as a bridge loan and give the customers actually better rates. Now you can do one of those loans with a DSCR to get even better rates, or you can do it without a DSCR, which is still going to give you better pricing than a bridge loan typically. The disadvantage is they're a slightly less leverage. You lose 5% of leverage versus your 12-month term bridge. But the advantage is that you're going to get a better rate. You're going to have the flexibility to not have that balloon coming due at the end of 12 months. So you have much more flexibility there in case interest rates do go up over the next 12 months and you want to hold off on refinancing for a little longer. No problem. If you're in a 12-month bridge, you're going to have to pay extension fees.
Makes sense. Thank you. I know that's a newer one, so that's great.
Yeah.
There you go.
We invented it.
Park your loan, wait for the market to change, buy yourself time, protection against delayed sales, no cash flow vacancy issues, pay down principal with fully amortizing or go interest only. So you get some optionality there. I like that. All right. Common objections and how to overcome them. I'm going to go through some more questions here because we got some more product type questions. Will you be able to send us the guideline when you send us the presentation? Yes, we're working on a public use version of the guidelines that is coming out in the next day or two. So we will be able to send that out. Let's see here. Michigan loans, California ITIN, DACA, what LTV from Guy. So Michigan loans, yes, we can do loans in Michigan. Let's go back up to our. Yeah, Michigan's definitely a state we're lending in. ITIN, DACA. I don't think we're doing ITINs on this, so if I'm not mistaken.
So a DACA would just be a foreign national, right? They don't have actually a legal status in the United States, so they're not a permanent resident alien. They're not a non-permanent resident alien. They are a foreign national. So we would do that under our foreign national program.
Okay. And then we asked, what do you have for Airbnb? Well, the Airbnb, I'm assuming you're talking about more of a our DSCR, a long-term hold. Let's see here. Our long-term.
Well, sometimes we do have customers that do that, right? They buy properties in vacation areas, and they do a lot of work to them to make them be a successful Airbnb, which we are absolutely fine with on the short-term side. And there are DSCR options to take out the short-term financing with as well.
Right. Let's see here. The DACA will have work permits, correct? Yes. So we will. DACA is qualified under foreign national program. Guy will get you information sent over. Just. copy that to clipboard. Guy will get you some information on here as well. For broker package, if you guys go to nonqmexpert.com, you can sign up right there to get a broker package. Just click sign up, kind of in the middle of the screen there. Then you can select any account executive you like. So if they're eligible for FHAs, would they be considered foreign nationals? Why would they be considered foreign nationals? Well, DACA is a federal program, and obviously this is private lending, so we view it a little differently. So that
don't have DACA does not have a green card or a visa. That's really what it boils down to. If you have a green card or a visa, then you're fine. We'll lend to you as if you're a citizen. If you don't have those things, then you're considered a foreign national.
Right.
In our programs.
Let's go over some common objections and how to overcome them. The interest rates on the short-term loans are higher than traditional mortgages, commensurate to their higher risk and shorter term of the loan. And some of those objectives, so how to overcome that is that the underwriting is heavily focused on collateral. The subject property, we're not underwriting the borrower necessarily. We do check to make sure they're not felons, and we do check to make sure that they have they have a decent credit history, that's 660 plus minimum FICO. There is no income underwriting or debt underwriting, similar to a NINA loan from the TRID days. But proof of reserves is required, so we are looking for some reserves. Matt, what kind of reserves are we looking for on these?
It's variable by experience, but the experienced customers are 6 months. So you have to have 6 months plus 10% of your budget plus cash to close. And less any cash out.
Yep, and you have to have you have to have that cash, because if you're doing a rehab loan, right, you have to have the money available to do the rehab work up front. You have to be able to purchase the materials, you gotta pay for the trades, whatever the case is, because we will not advance you the funds on your work until you've documented that the rehab work has been completed. So we can't just say, oh, hey, you don't have any money, we're gonna go ahead and let you do this. We have to make sure that we're validating that you have some cash in the deal. So that is important. Let's see here. Seasoned investors will produce their own return on investment analysis per project. Variances in interest rate will make very little difference in the project's overall profitability and performance. So what that means is rate is not as important to somebody because they're only borrowing the money over a very short period of time, and we're only charging them interest on the loans for a very for whatever they're borrowing. So they could borrow, they could take out a loan for $300,000, borrow $100,000 of it, and then maybe after 9 months borrow the rest of it once they've completed more of the work or finished some of the work. So we're only charging interest for a very short period of time. If your borrower is not producing their own ROI, produce one for them. It's easier to show a borrower with hard figures how their profit is nominally impacted by variances in interest rate. So again, we can share with you guys that this entire presentation, so that has how we calculated all those returns for them. Providing information is easier than haggling over rates. Your anticipated total cost of this loan is X, which means that based on your anticipated after renovated value, your expected net profit is X. If the interest rate was reduced by even 2%, then the difference is only a very little bit amount. So it's not very much. The true profit in this deal is your acquisition price, not your rate. You had mentioned you may complete the renovation in 6 months, which would further improve your bottom line figure by whatever dollar amount. So these are ways that you can kind of help take interest rate out of the equation when you're selling. So origination points, if the borrower can provide a written LOI or a written quote from another lender, we'll do our best to look at that. Processing fee, the most expensive fee on our LOI is the lender fee, and is estimated at $12.95. The overcoming objections would be that our fees are some of the lowest in our space. We shop our competition on a monthly basis to ensure our offerings are competitive. We also don't charge fees like a closing fee or a project feasibility fee, which some of our competitors do. And that's kind of the end of the presentation. We're running up right on the hour, so we have about 4 minutes, it looks like, to answer some questions. If you still here with us, Matt, for a couple more minutes. Try and get a few of these up. Let's see here. So you allow purchases where the funds are coming from a self-directed IRA and the closing in an LLC. I have a borrower that is looking for this type of financing, but it has to be a non-recourse loan. So the title title would be in the name of the trust that handles the self-directed IRA. Is that okay?
All of our financing requires recourse to the guarantor, so it doesn't work for that situation.
Okay, sorry, John, that's not going to be one that we can do. JB, I'm assuming I think I know who that is. At closing, there will be a first draw and there will be an initial set of improvements. I don't know, there's a question there. Some clarity about the ratio for DSCR you were using for the ratio for the current mortgage payment and rental income, or the anticipated rental income and new mortgage payment.
So we don't do a DSCR analysis on SFRs, condos, 1 to 4 unit properties, right? We only do it on multifamily, and on multifamily it's a much more complicated analysis because that's when you get into kind of your commercial space where you're looking at vacancy, you're looking at capital expenditures, all these numbers that need to be figured in to a multifamily underwrite is what we use. So it's a little different.
Hopefully that answers your question, Francisco. I know that it is different if we're doing the Bridge Flex program or if we're doing the standard bridge or if we're doing a fix and flip. We're not, it's gonna be dependent. If we're doing a long-term DSCR, then obviously everything's gonna be based on what the new one is.
That's a good point, Chris. The Bridge Flex does have a DSCR option. So that would be lease or 1007 rents. Those would be used to qualify the DSCR on that.
And will there be a disbursement? Will there be a disbursement of the first draw at closing per the budget? I think that
no, that would be like pre-funding a budget item. So basically what's going to happen is that you're going to get your initial disbursement is going to be based on what is in existence at the time of the property being appraised. Any work the customer does, let's just say somehow maybe it's a refinance and they started work during the process of the loan, they would have to wait to submit the draw till after closing. It usually actually takes the loan a couple of days to board before we can get a draw done. But they can submit it right away and we can get anything we need cleared out of the way so that as soon as it's boarded, we can actually fund it.
Good. And then the question was, we got one more question. I think that's going to be it. I think that's the end of the questions here, but I'm still unclear on the lender's fees. How much do they charge for a seasoned investor and how much do they charge for somebody with no experience? And I think that I'll try and answer this, Matt, and you can smack me around if I'm wrong, but it is based on the LTC. So it's going to be based on leverage and it's going to be based on also on their experience.
It's experience and credit. So it is, there's a couple of variables there that kind of change things. But I think the easiest answer to that is the lowest it will be is 1% origination plus the 1295. That's your best experience, good credit customer.
Okay.
Everyone else is going to pay more to some degree, but it varies. So we will easily give them a quote that shows you exactly what the payment or what the fees are going to be, and they are not going to change, right?
Yeah. All right. Matt, anything else that you want to wrap up with that we missed? Didn't touch on? Didn't get a question asked about?
I think you asked me earlier, and I kind of forgot to mention it. And one of my answers, it was a multi-part question, was that the repeat nature of this business is really key, and that's what we've really learned over the years is that these customers do, on average 4 to 6 loans with us a year. A little over 60% of our business tends to be repeat customers, and that's a big reason too why we do have that in-house project management team. Because we want to be able to control that experience for the customer. What we've found is that most companies outsource it. We actually used to outsource it, and it just doesn't give the customer the best experience. And we really want them coming back because we know that's what drives this business.
Perfect. And if why would I use you versus somebody else? With a weird name that sounds like some kind of fruit. I would say, because of that right there. we want to make sure that your customer has the best experience so that they want to come back and deal with you again, and they want to come back and deal with us again. And we want to make sure that we're all able to enjoy the benefits of providing good service and that repeat business for your customers time and time again. So with that, Matt, thank you so much for joining us. I know we had some technical issues there with some feedback in the video, but it all worked out. It was a great hour spent on this call. Thank you all in attendance for joining us. Go ahead and check out the website, nonqmexpert.com. You can get your broker package there. Because you joined the meeting, we're going to go ahead and send you out a copy of the webinar, copy of the PDF document that we went through. And if you guys have any questions, feel free to email. The email address is on the screen there, marketing@oaktreefunding.com. And we look forward to talking to you guys and doing business with all of you real soon. Thanks a lot, Matt.
Thank you, Chris. Thanks, everyone.
Thanks, guys.